Assalamualaikum and hi everyone. Welcome to Principal Malaysia's 2023 Quarter 2 Market Outlook. I'm Farah Sapari and I'll be your moderator. We have with us Mr. Patrick Cheng, CIO of Principal Malaysia and Equities, Principal Southeast Asia. We also have Mr. Jesse Liu, CIO of Fixed Income Southeast Asia, and Mr. Lee Chun Hong, Head of Equities for Principal Malaysia. And with that, let's kickstart our conversation. Hi, Patrick.
Hello.
So, the financial markets had a strong start in January, but volatility resurfaced in February and March due to concerns over inflation and the implication from interest rate tightening. Could you provide a summary of the market's performance thus far?
Yeah, so what happened was that people forget that the rally did not start just in January. The rally actually started in the beginning of November, right? Or late November, when the market started to price in a reopening from the Chinese economy. And that happened in December. And obviously markets, as you know, are forward-looking, and they basically started to price that in. It was a very, very sharp rally, right? Close to about 40% on the head share. So obviously when you get a very sharp rally, you will get a retracement, and that's what we had. So I think this is a very healthy correction in what we call a rather strong positive outlook on the Asian markets, on the back of the fact that, yes, there is some inflation pressures, which I'm sure Jesse will talk about. Yes, there's some issues on the geopolitical front. Nothing really new there because we all know that happened last year already. So I think, generally speaking, I think investors need to think about the fact that this is a minor correction in a very broad rally, and we continue to be very positive on Asia in 2023.
Thank you, Patrick. Also, Jesse, how do you look at the fixed income market over the past few months?
Hi, Farah. So I think where we are at this juncture is environment seems to be a little bit more stressed out, largely because what has happened in the past 2 weeks over at the financial sector in Europe. And because of that, we are seeing investors trying to asset allocate themselves back into safe assets. So if we look into the fixed income asset class, globally, we had a strong rally in January. We have another correction, like what Patrick mentioned in February, but in March, largely, is a positive month for fixed income because of that change in dynamics in the financial markets over in Europe.
Thanks, Jesse. Now back to you, Patrick. So considering the near-term concerns, such as financial sector turbulence, policies and uncertainties, and the divergence in inflection points for different markets, how do you view equity portfolios from an asset allocation strategy perspective?
We've said this many times. I think the equity asset class obviously will form some form of volatility in the short term. Secondly, I think that, yes, there is some form of volatility, but equities as a whole over the long term should be able to weather through all this kind of volatility, right? Now, what we've heard over the last 2 to 3 weeks, obviously, is two idiosyncratic issues, right? One of which is SVB, Silicon Valley issues that are happening in the US, and of course, lately on Credit Suisse. Now, these are what we call idiosyncratic events that it's happening in the background that the economy actually is still doing fairly well globally, right? Yes, there is some issues in Europe. Yes, there are pockets of basically stress, for example, in the property market in the US, but I don't think this is going to basically put global markets or global economy into what we call a deep recession. Our base case is that I think the global economy should have a soft landing. Of course, it's a moving target, but I do believe that we are in the camp where we do believe that there's going to be a soft landing. In that backdrop itself, right, we are hopeful that at some point, by maybe the end of the year to the early 2024, when we do get this whole thing, the big R word, which is called recession, and people start to price that in, then I think the yield curve and the financial markets will start to price in what we call lower rates. And generally speaking, history has shown that if you have lower rate expectations, then of course the market will reprice itself, right? And so people will talk about basically Fed cutting rates and so forth. We're not there yet, and hence you got the choppiness in the short term.
Okay. So let's turn to Jessie now. So while we had a predictable interest rate direction based on the US Fed dot plot, recent events such as the turbulence in the financial sector have altered this dynamic. So as a result, the future market is now pricing a different direction on the pace of hikes going forward. So what is your view on this matter, and are there any potential implications for fixed income assets as a whole, particularly in Malaysia?
Yeah, so I think fixed income assets in times of stress continues to be attractive. But I think for this market, one thing we want to be cautious of is that inflation is still there, right? Regardless of how much the Fed or global central banks has hiked rates, somehow inflation is still about there. The different dynamics that's playing out is, of course, when we have a high interest rate environment, we are probably going to see the economic environment becoming a little bit more stressed out. So because you have these two dynamics playing out and none of it is yielding, you'll probably continue to see a little bit more of a volatility in fixed income markets, where people are trying to price where there's going to be more hikes or some cuts in there. But generally, what we can see in terms of patterns is that the expectations won't be like what we saw last year, whereby it's just one-sided. It's just about inflation, and then you see a lot of hikes. Right now, what we are seeing is that different parts of the world where inflation is much more contained, you see the central bank already stopping their interest rate high cycle, or what we call a pause in those markets. Where the markets that is not that hasn't reached there yet will be those like the ones in the US or in Europe, whereby you still see interest rate hikes coming on. So when we look at the fixed income market broadly, then the choice, of course, will be in some of the markets that we are more sure of that the cycle is at its peak, whereby we think the long duration strategy is more understandable. The thesis of investment in longer duration it would give you more chances to generate alpha rather than compared to a market where we're going to see more interest rates coming in.
So my next question goes to Chun Hong. We saw Malaysia's economy grew at the fastest pace, expanding 8.7% in 2022. With sentiment now also gradually improved post the Budget 2023 event, what is the outlook of Malaysia going forward? And are there any particular risks that investors should remain mindful of?
Good, thanks, Farah, for the question. So yes, Malaysia have one of the highest GDP growth the history of also in the region. But bear in mind also last year, we also experienced for the first time we have a hung parliament post the 15th elections. So with that in mind, we reckon that the market has very low expectation, judging from where the KLCI is trading right now. But of course, I mean, the expectation of the government to deliver is also at the high side. So that's a dilemma on both sides, the market expectation and the expectation of the government as well. And so with the weakening outlook on developed market, so you need to to take into consideration. So we expect the economy to remain softened. And so in this current juncture, to push the market higher, the government need to come out with a blueprint or master plan where they want to position Malaysia in this China Plus One strategy in the medium to long term. But of course, at the same time, so we are waiting to feel the impact from China reopening in this part of the world. It's still too early to tell whether it will come or not to pre-COVID level. And so another thing to bear in mind is, for the first time in 2023, all the major festivities are being front-loaded. So we had Christmas, followed by Chinese New Year, and then school reopening, and soon Hari Raya. So there's a risk that domestic consumption could slow down more than expected after Hari Raya this time around, especially if China tourist inbound are slower than expected. So there's one risk to bear in mind. And lastly, external risk aside, we need to monitor closely the stability of this government and also clarity on the government policy and how they want to bring Malaysia forward. So something that we're watching very closely for Malaysia. Yeah.
Thanks, Chun Hong. So let's talk about the Asia-Pacific region. It's great to hear that World Bank has revised its growth projection upward for Asia and China. So Patrick, do you think the region has reached a turning point? And could you walk us through the key drivers of this optimism and share some investment opportunities that may benefit the investors?
Sure.
So the thesis on Asia is a very simple one, right? So it is really on the back of the reopening of China. What does that really mean? It really means that the second largest economy in the world finally reopened its borders. People can go in. I was just in Hong Kong last week, and people are basically resuming their lives and so forth, right? Manufacturing PMIs, services PMIs, all the indicators that all the clever economists look at are all rebounding from a very, very low base. Now, the next question you're going to ask is, how far can this go? So basically, they came out with a projection on GDP about 5%, and I think, largely speaking, 5% is a doable number, up until at least 5.5%. That is one of the highest GDP in the world, right? From developed market point of view, from a very large G7 countries point of view, right? So I think you need to put into context that if you do get a slowdown or a mild recession in the US or Europe, the economy that is still doing well are in Asia, right? China is doing well, right? Malaysia is doing fairly well. Southeast Asia is doing well. So these are pockets of opportunities that if you want to buy growth in equities as well as in fixed income, this is where you want to put your money. And hence, from an asset allocation basis, yes, you can call me biased towards equities or towards Asia, but ultimately, this is where the value is. Because people forget that we've had a lockdown for more than almost 18 months the last year and a half, right? So when you reopen, there's going to be pent-up demand, right? People are going to go shopping, people want to go holidays, people want to consume, right? So that's where it's going to drive the economy. The other point that I wanted to highlight as well is policy making in Asia itself continues to be supportive for growth. It's very important. What did I mean by that? It really means that the monetary policy that we have with the inflation numbers that are more benign compared to Western worlds are going to be supportive for growth, right? At the very margin, right? So I think those are two major factors. And the last point is, never been a better time to invest in Asia, especially in equities. Why? Because ultimately it is very, very compelling from a valuation point of view. Now, if you don't want to be in China and you're scared about China policy, for example, argument, then you've got Southeast Asia, right? And ASEAN is a very defensive region in Asia, which continues to be supported by commodity prices, supported by consumption, supported by foreign direct investments, and so forth, right? So I think you get a combination of growth and income in Asia, and I think that's supportive of our bullish view on Asia equities.
Thank you, Patrick. So now, Jun Hong, I'd love to hear your take on Southeast Asia. So it's been an interesting year so far, with the region standing out in many ways. So what investment opportunities do you think still has potential to drive growth for the rest of the year?
Thanks. You have already pointed out ASEAN market has kind of graduated from primary school as secondary school. Just judging from the performance of the currency in this volatile period, we fared fairly well, unlike in the past, 2013, when any crisis happened. Indonesia, Philippine peso will hit quite severely against the US dollars, so it has changed quite a fair bit. But as what we guided in the first quarter outlook, we say that that's a potential rotation flow from laggards to from winner to laggards. For example, from ASEAN to North Asia, which happened towards the late of November, like what mentioned by Patrick. So when China reopened, so a lot of flows are flowing back to North Asia, and in particular China. Okay, but if we break down the ASEAN market into respective markets, generally only Thailand and Malaysia underperform. And why they underperform? First of all, these two are trading nations, so they export a lot to developed markets. Secondly, these two markets also, the central bank has raised the interest rate more moderate as compared to Philippines or Indonesia, that is more aggressive, even Singapore. So the banks in this country has outperformed, whereas these banks in Thailand and Malaysia underperformed due to that slower pace of rate hikes. But against the rising volatile period I mentioned by Patrick, ASEAN is a place to hide because they are low beta, and as I mentioned, they kind of graduated into secondary school quite nicely, looking just performance of the FX. And so there's a lot of growth to be expected in this region. We think they can avoid potentially the recession, the big R words, judging from the way they are just come from lockdown, and also with the reopening of China, and we rely quite a fair bit on the tourism receipts. That's potential is in ASEAN for the next 6 months to 12 months.
So before we wrap up today's session, I believe what is in the mind of many investors would be the direction of the market given the recent shift in market dynamics. So what is the best advice for clients in terms of asset allocation in the near term? Patrick, maybe can we hear from you first?
Yeah, our view is that I think in a fairly volatile marketplace, both, especially in the equity sense, you need to think about asset allocation towards a more income-based portfolio. Income meaning either fixed income, other money markets, right? We've been saying this for the last couple of months simply because I think when you get into an environment where a lot of the yields of fixed income portfolios tend to look fairly high at the moment, you want to be put in there. Now, having said that, I also believe that if you're more growth-oriented as well, that you need to think about equity portfolios, particularly in China or in Southeast Asia, where I think the valuations and as well as the growth opportunities over the long term continue to be very compelling. So in a nutshell, I think the last thing you want to do, and that's my parting word, is to hold on to cash, because your cash holdings are going to be eroded by inflation, right? In an environment where inflation is high, right? Whether you go to Kopitiam or whether you go to a nice nasi lemak place, everything is going up, right? So if you put money into cash, you're not going to make that much money. So if you have a portfolio which gives you both growth and income of a return of about 5 to 7%, I think that will basically be able to negate any kind of inflation pressures in your wealth of your family,
Okay. Yeah. What about you, Jesse?
So I think for fixed income, like what Patrick said, it's very attractive. We have higher yields right now to date. The one thing that I would want to just highlight in addition to that is that if we look into global markets right now, there are pockets whereby you see yields are extremely high for fixed income. And that is with a reason, because environments are much more challenging. And of course, if you look into other pockets like in Europe, the banking sector, yields are even higher because of what we saw for the past 2 to 3 weeks, right? So in our allocation, of course, I think some duration is something that we like because we can see in the foreseeable future there's a pause. But at the same time, we want to be very cautious with our asset allocation when it comes to credits. We want to make sure that the credits that we have in our portfolio continues to be very strong. That is a key thing for us. And so we have been doing credit investments for a number of years now. We have more than 2 decades of track record. And we pride ourselves to be someone that looks into credit very deeply. And I suppose for investors, credit is something that you really want to look into more deeply at this time around, largely because there's a lot of uncertainties in the market, and you just want to protect your portfolio in that angle too.
Okay. Thank you, Patrick, Jesse, and Chun Hong. And for everyone watching, we hope that this quarter's market outlook has provided you valuable insights and information to help you manage your long-term investment goals. Thank you, everyone, for tuning in. Stay safe and take care.